Hey guys, thanks for tuning in. This is Spencer Crenny with Alkaline Advisors, and I've got Sam Palmer here. Sam is one of the brightest minds I've come across in real estate over the last 10 plus years. And we really wanted to pick his brain to see what knowledge he has that he can then share with the rest of us. We're really big about giving back, and we're trying to see how we can educate as much as we can. So with that, I want to introduce Sam Palmer and allow him to give a little background into what he's been doing across his career. And then we'll talk about the state of the industry. We'll talk about do's and don'ts and just keep it pretty casual. So Sam, thanks so much for agreeing to come on this call.
Thanks, Spencer. Appreciate the intro and happy to help and lend some time and help educate the people about what's going on in real estate. For me, I'd say for the past 15 years, I focused primarily in the multifamily sector. Worked for some large institutional owners and investors, anywhere from companies that had 5,000 units all the way up to 80,000 units, and spanned the gamut from, acquisitions, capital markets, asset management, construction, and development, which is kind of our folks right now, building throughout kind of the Southeast. Before that, spent 15 years as a developer and was far more opportunistic, doing everything from large tract land development to urban redevelopment and everything in between.
Awesome. Yeah, I know you've had quite the career, and we're also in a very unique time in the industry. There was a lot of hesitation the past couple of years, and I know when we spoke at NMHC, we continue to hear the term cautiously optimistic being thrown around. And I thought that was the case in January and the first half of February, but it seems like things are a little shakier now, just with all the uncertainty going on. What have you seen from your conversations or just kind of your day-to-day in the development space?
On the development space, every time we see a soundbite hit the media, it causes a ripple effect with every one of our partners and operating partners as well as capital partners. Whether it's the word tariff or trade war, that immediately makes people worry about the cost of doing business, and it should. Whether it's being utilized as a negotiating tactic or it's something that's going to be part of the overall economy, still remains to be seen, but we do know that it's going to impact our ability to not just continue and get something built. We've got something coming out of the ground next month, but also determine the feasibility of a project, because we know that it can impact everything from minor items all the way up to significant commodities, whether it's the price of a light switch being manufactured in China all the way up to the price of lumber.
And how are you preparing for the potential ramifications of these trade wars or tariffs?
So we have a pretty deep bench of consultants, general contractors, architects, suppliers, and we're on the phones. We're constantly calling and saying, how does this impact your specific trade or this area? And understanding if it does change the math. Are we dipping into a contingency fund in order to make something work where the overall project still seems to be on solid ground? Or do we need to look at the cost of doing business where we have to say, okay, our construction costs might have gone up 5, 7, 8, 10%, depending on where we're at, to really understand the true impact. And if it moves the needle to where the project becomes a little bit tougher to pencil. I think for the deals that are further out, it makes it harder and harder to understand, but at least something where we may have, let's call it design drawings and construction drawings where we're actually bidding something out. It's easier to concretely say it affects it one way or the other.
Yeah.
On the capital side, it's different.
And you mentioned that ripple effect, right? So rippling into the capital side, how has that impacted your ability to structure deals or raise capital, whether it's debt, equity, or something in between?
For deals that are in the mix right now, again, when we talk about changing the math and making something feasible or not feasible, that doesn't always make a common equity partner who's already afraid of their own shadow right now necessarily want to come out and participate. It makes the guys that are doing some of the pref and mezzanine pieces want to make sure that they're still adequately protected, that there's enough cushion above them to where they're not taking anything back. And as far as the lenders go, the lenders right now are sitting at between 45 and 50% of cost. So it takes a while for it to actually flow through to them. But at the same time, you've got so many different tests at the back end of a project that you have to be able to pass to make sure that it's still feasible for them to lend on. I think that they're worried that a few points here and there really does affect their feasibility to affect the loan. We haven't seen anything where somebody's so nervous that they pull out. We just had a tremendous amount of requests for information from all levels of partner.
Got it.
The thing that I'll say is it's moving so quickly that we're starting to get requests for information that basically are macro instead of micro to our project, because they may have other deals that are floating around and nobody has the answer. They're looking for an answer. They're not confirming what they think. They're literally polling all of their different partners as well to say, if I've got, in the case of the bank that we're working with, 500 or 600 construction loans out, they're trying to figure out what that means to their, exposure. And if we've got a common equity partner that might only have 3 or 4 or 5 deals going like we do, they want to understand what our approach is going to be to manage this, because in this case, it's a co-GP with another development group. And our pref partner has a lot of different, elements out that they're trying to figure out what this will do, not just for our project, but for all projects.
And what are some of these macro questions that are looking to be solved?
How are you going to deal with the tariffs that are coming out of China or Canada or Mexico? Simple question with an incredibly complicated answer. And what it comes down to is understanding now, you've got to become a supply chain expert. Where's my HVAC being manufactured? Where's my raw materials coming from? And then the final product being manufactured and then crossing a border that's going to trigger a tariff. How much can I buy domestically? How much can I build domestically? So it's things like that you have to answer the questions. I'm not a general contractor. I hire them to have a lot of these answers, but at the same time, it's so new that we all need to treat this as a true partnership so that we're all going in eyes wide open and working together to come up with solutions. So there's no one expert that's going to come in and say, I've got the solution for this. It's going to be all of us coming together and understanding. Maybe the lender who doesn't like us to prepay for a certain amount of material has to get comfortable with that. Maybe the equity partners have to be comfortable with better inventory controls and security controls in place so that we can warehouse material now so that we don't have to deal with that. During COVID, that started to become more frequent because of supply chain issues related around the pandemic. Now it has to do with potential trade war.
Mm-hmm. And you had mentioned a project of yours you're currently focused on. Can you give us a little more insight into what that project looks like?
330 unit garden style apartment buildings in Savannah, Georgia. We're very bullish on the Savannah market. We love the story surrounding the Hyundai plant that's there. We could probably take a lesson from Hyundai. They're a vertically integrated group, so they're building all of their EV cars there in Pooler, Georgia. And with that, the surrounding area is going to benefit because the people that make the seats, the people that make the steering wheels, the people that make the windows are all going to have some kind of an element either flowing into the port, coming down the freeway, or being built in that market. So there's a tremendous amount of industrial surrounding that. But understanding kind of how you control that supply chain, whether it's through third-party suppliers or doing it yourself, is a lesson that we could probably take a page out of. But because of that market, because of the jobs that are being created, not just on the plant, but the ripple effect from an economic development standpoint, we really think that Pooler is the place to be right now from a development standpoint as well as an investment standpoint. So we've partnered with a group. We've bought some land in a master plan community, and it's fully ready to go. And now we're just finalizing all of our capital structure to break ground probably within the next 3 weeks.
Congratulations. That's pretty exciting, especially in today's climate. I feel like not many people are able to get a green light on these projects from lenders or investors or just internally, right? Figuring out how things will pencil.
And we had to get creative on that capital structure. So when we bought the land, it was underwritten with a 60% loan to cost construction loan and a 90-10 joint venture partnership with a institutional capital partner. And what we've ended up with is a 55% LTC construction loan, a slug of pref, taking it up to about 70% LTC, and then a co-GP with another developer, which is basically capitalized like we are with a family office behind them.
Got it. And are you finding that more and more frequently you do have to get more and more creative with these structures?
It doesn't matter if it's an acquisition or a development deal. You have to be agile. You have to be able to pivot. And if you've got conviction in the property and the project, you need to find somebody that shares your vision. And that means going to alternative capital sources.
Mm-hmm. Yeah. You mentioned finding conviction in property, project, and then I'm going to expand that out to market as well. What are some of the factors, or key factors, I should say, at play when you're determining your investment thesis, right? Markets, projects, properties, you're looking to spend time analyzing. I think that's one of the major questions that we get from some of our clients and some folks in the industry. They're just not necessarily trying to find opportunities, because there could be opportunities everywhere you look, but what market do you even look towards?
It really depends on where your comfort lies. So you could say that certain markets have been beaten up because of the significant amount of inventory that's being built in them. But at the same time, there's a significant amount of demand behind that. Now, it might be overbuilt today, but in the long run, those units will be absorbed. So if I was investing right now, would I consider a Phoenix, a Nashville, a Dallas, an Austin, a Charlotte? Yeah. But I would be very careful about what my basis is and be very realistic on what my underwriting looks like in the first few years while those deals absorb. But once that happens, I still believe that there's a tremendous amount of people and employers that want to be in those locations. When it comes to development, I probably would treat any of those as a potential land bank for future development, but I wouldn't want to try to compete right now. And that's why when you look at a Pooler, Georgia, and a Savannah, Georgia, where I've got the demand there based on what's happening from an employment standpoint. And yeah, there's 1,000 units coming online next year, but 1,000 units doesn't scare me when you're talking about the potential for 40,000 jobs. If it was 40,000 units and 1,000 jobs, yeah, I would not be there. But when I look at markets like Orlando, slightly overbuilt right now, well, significantly overbuilt today, but in the long run, do I think that it has the potential to absorb and continue to grow? Yeah. So I would probably land bank or be buying from a good basis from a developer right now. Absolutely. Same with South St. Pete. I love Pinellas County here in Florida. But if I was across the bay in Tampa and Hillsborough, Pasco, I'd probably have a little pause, because there's a lot of projects, a lot of inventory, and a lot of available land. Whereas in Pinellas, there's not a lot of available land. So you have to look at not only the overall macro of the market, but also the micro location. You could say there's other markets in the U.S. that have maybe a mercurial upswing, downswing cycle, like the Houstons or the Las Vegases of the world. Houston had a lot of units come online, particularly in a handful of micro locations. But I still think overall there's potential for Houston to grow. That economy is diversifying. It's not purely just based on energy. In Las Vegas, yeah, COVID proved that 600,000 people can be furloughed or laid off in 1 week because the hotels and casinos closed, but then they bounced back. But they bounced back in a city that doesn't have a lot of inventory being built. So you don't have the same situation that you have in a Phoenix or a Denver, where there's a lot of units coming online. So there, I'd probably be looking to build as well as buy. So I just think that when you look at market analysis, you have to not just focus in on a headline and say, oh, this is a bad market or this is a good market. There's a lot of developers that built multiple units for one renter showing up, but it's one renter this week and one renter next week and one renter the next week. So eventually the absorption happens. Mm-hmm. And then other markets where you're not seeing a tremendous amount of inventory coming online, sometimes you have to ask yourself why. I have a significant presence in the Midwest from an investment standpoint. I love the Midwest. It's tough for me to understand how deals would pencil to build out there. So even with a great basis in the land and long-term patient capital, I'm still probably more bullish to own there than to build there. And it's great because of that lack of inventory. It's probably one of the few regions in the area that has consistent organic market rent growth. But that's not enough of the story. It's just one element of the story to hone in on.
Yeah, those are great points. What excites you the most going forward in terms of development opportunities across the U.S.?
I think that when you look at a market cycle, and not the macro market cycle, it's again kind of market to market, and you look at a place and if you have that conviction that I mentioned earlier about that market and about residential investments, you sometimes say, am I timing the market to build or am I timing the market to buy? And I think from a development standpoint, I see a lot of those headlines talking about the inventory that's been built and that it isn't absorbing as quickly as possible. And there's a certain amount of distress related to that, whether it's throughout the capital stack or the property itself, which means that you're already seeing it happen where permits and starts are tapering off or tailoring off or jumping off a cliff. That means that, in about 2 to 3 years, you're not going to have a lot of inventory coming online. So the people that are really entrepreneurial right now that do have that kind of conviction are most likely lining up to buy either fully entitled land or land that's close to entitlements or fully baked projects, and going to time the market by starting in 2026 to deliver in 2028, when inventories in a lot of the markets that I just mentioned don't have a lot of inventory coming online. And yet they still have consistently, 6, 7, 8, 9,000 units that are absorbed every year. So you're starting to see that as a potential opportunity. And then other places, it's I utilize the analogy of a truffle pig, sniffing out that perfect situation. And I think that there are a handful of markets, whether you're going to chase Taiwan Semiconductor throughout the Phoenix Metro, building all of those plants. That's a hell of a lot of construction and a lot of permanent jobs that are going to need to be housed, or all the activity that you're seeing from the chip standpoint up in Columbus. If these trade wars really do require a lot of things to be onshored, do they start firing up some of the auto manufacturing plants throughout the Midwest again? So it's looking for that activity at the employment level. It's going to make you comfortable pulling the trigger and saying, this is a market that I need to do more investigations on, and I want to invest my money in, either in the short term, 3, 5, 7 years, or the long term, 5, 10, 15 years.
And where are you in your truffle pig sifting right now?
We're focusing primarily on Central Florida and Southern Georgia from a development standpoint. I think that there's still a lot of opportunity for the next 10 years in that Savannah pocket. And I think that the cycles here in Florida are shifting, but you're still seeing a lot of people wanting to live here, whether it's the retirees, whether it's people fleeing high tax states, employers that are coming down here and either setting up shop as a secondary campus or relocating in full. But I tend to gravitate to Central Florida. I think that the Southwest doesn't have as much infrastructure that I'd be comfortable with when it comes to some of the exposure to climate risk. All of the different hurricanes have a tendency to target, either Southwest Florida or the Panhandle. And then the infrastructure pressures that are happening down in South Florida are a little worrisome. So as much as I like Palm Beach County for a lot of the reasons I like Central Florida, Broward and Dade are different animal. And Jacksonville is a tough market to get your arms around sometimes. So one day you love it, the next day you hate it. And for us, jumping across the border into Savannah made a lot more sense than trying to force something in Jacksonville. But the reason that I like Central Florida is, I-4 has become basically one giant metropolitan area. I like the concept of corridor cities. And when you look at what's going on in Orlando and what's going on in Tampa, it's primed to allow for a tremendous amount of growth. And you're seeing that in Lakeland. I think Lakeland's the number one city for population growth in America right now. And it makes sense because as those two cities grow together, it's only logical for it to kind of follow that path of progress along I-4. There are corridor cities that I like in other areas. You see that in San Marcos, Texas, between San Antonio and Austin. You see more activity happening, kind of along that corridor along I-35, going between Austin up to Dallas, along Waco, Killeen, that area. So yeah, I think that as cities tend to grow together, that concept kind of plays out. But for us and our team, as much as I like to be in multiple states, it's a better use of resources for us to focus here on the I-4 corridor in Savannah.
Got it. Yeah, all great points. What else are you seeing out there right now that you think you have a good grasp on, or you're able to wrap your arms around a little better than most, just because you're in the batting cage taking cuts on a daily basis, right? You're looking at all these different markets. You're picking up on those macro trends you mentioned earlier. What can you share with someone who maybe he's only focused on one market, or maybe has a more myopic view on the industry in general?
It's wonderful that I've had the ability to play at a national level for so long, because I treat the country the way that myopic investor might treat their metro area. You could say Frisco in North Dallas is overbuilt, and then there's an area in the central part of the metroplex that's maybe underserved. You can go over to Tarrant County and get a totally different demographic, but still make something pencil. So it just depends on the market that you're in. There's always the ability to find something and make it work if you're comfortable with understanding the timing. The piece that I would say is right now, people trying to force a deal, this is not the time to try to force a deal to work.
And can you go a little further into that concept of understanding the timing?
Yeah. So, kind of coming back to understanding your market analysis and being realistic on your underwriting, and understanding what capital wants. It's interesting. There's a lot of capital chasing deals in the markets that I said were overbuilt, and it's because they're the right market. So sometimes you have to listen to what capital is saying, and really try to find out, maybe I missed something along the way that I need to hone in on and do a little bit more investigation. I might have every metric on a market analysis report that says I need to put all of my money right now in southern New Mexico because the border is going to heat up because of what's going on from our administration. But at the same time, to me, that feels like a boom town, similar to what happened during the shale era up in North Dakota. So no, I don't want to invest a tremendous amount of time and energy and resources down there. I think that forcing a deal because you feel the need to place capital is probably the wrong reason to be in this business. There is opportunity coming. You are starting to see a little bit of a shift in the bid ask between, on the investment side, starting to see land become more available for future development. But what we've seen is where we might have been 20% off between what we're willing to bid for a deal and what the seller wants. That might be shrinking to 5 to 7%. And we're starting to get to the point where, maybe a Fed rate cut and a little bit of relief on the debt, and a capital partner that's willing to take maybe a slightly lower return going in is willing to transact. That's the reason to say, okay, now we maybe should be back in the market. But if we're that far off, it's tough to say, hey, just add an extra $1 million, you win the deal. Yeah, I won the deal, but did I just give my guy a 6% return when he was really targeting a 12 because I wanted to force something to happen? I just think that there's a lot of opportunity to find deals, but you have to be able to be disciplined enough to say, not just yet. It's tough because I could say right now there are markets that if a deal becomes available, you're going to have a feeding frenzy for. And there are other markets where there's a lot of deals on the market. And I think it's because of the timing of the cycle. This, from an annual standpoint, we're out of NMHC, a lot of deals launched, a lot of activity happened. People got excited, and then they realized, oh, wow, you want $100 million for a $60 million deal? It's not going to happen. So I think it just comes down to understanding how to time either your reentry or your continued investments within these markets.
Yeah, it's a really great piece of advice. Do you have any other, I know we're coming up on time, do you have any other pieces of advice that you'd want to share? If you had one takeaway from kind of what you're seeing right now, and someone asks, hey, I have a question about what I should do going forward, like, give me some good answers.
So you use the words cautiously optimistic. And I know we love our buzzwords in this industry. Okay. You're right. That's kind of the theme for this year. What I would say is really focus on those two words individually. You still need to be cautious. Do not do something rash. It's what I just kind of rambled on about a second ago. But at the same time, don't get discouraged. Okay. If you've got conviction, you need to find those that have that same conviction and figure out a way to use that alignment to get something done. All right. If everybody in New York tells you that they're not transacting right now, but you have conviction in workforce housing in the Midwest, and you've got the ability to put good debt on it right now with either the agencies or a debt fund or any of the new groups that are out there raising capital around multifamily, and there's a pref partner available for every deal right now. In order to find that partner that you've got alignment with, maybe you need to expand your network and look outside your borders, look outside, the traditional sources. Try to find the group that's willing to share that vision, because I think there is a way for you to be able to get something done. But where, for a long time, there was a lot of capital flowing into multifamily, into real estate in general. A lot of those spigots have been turned off, but you just need to go find another way to tap into that line and get capital to your source. And I think the optimism piece is just don't get discouraged. Everything's on a cycle. A lot of people are now weathering their first down cycle. I can't remember how many I've been through. I know it's greater than 5, and it might be closer to 7. And so for me, you make more money as that down cycle starts to turn up than you do at the peak of the market. So maintain that vigilance and keep staying optimistic, and try to find the right alignment with your partners, and you'll see things start to happen.
Awesome. Yeah, the spigot is definitely more closed now than it was a couple of years ago, but it's not off. And I think it's water's starting to flow a little faster. But to your point, you have to be creative. And if you have to tap in to the line kind of from the back door, then you got to make it happen, right? No one's going to make it happen for you. So yeah, this was awesome, Sam. I really appreciate your time. And I know we're going to try to do these weekly now. So I think this was a great chat. And with that, Sam Palmer, thank you so much for your time and your brain, and talking us through some of the info you've learned over those 5, maybe 7 downturns that you've weathered. This will just be another one to add to the list. So again, this is Spencer from Alkaline Advisors. Thanks for joining, and we'll see you next week.
Sure.